Hello everybody, this is Brad Zara and I'm going to talk about bonds. A lot of you have heard about bonds, but you probably just didn't understand what a bond means. You've heard about stocks, you've heard about options, futures, and bonds. Today I'm going to talk more about bonds. What is a bond? What does it do? You've heard a lot about those interest rates going up and down. What the hell are those interest rates that they talking about over and over again? Alright, so basically bonds is issuing debt. A company, it doesn't have to be a company, but I'm giving an example. For example, a company needs to raise capital. How does a company raise capital? In two ways. The first way is issuing debt. It means borrowing money from the people. The second way is selling ownership in the company. That means stocks. But whenever it issues debt, that means it's securitizing it in legal contractual obligations. I'm going to draw something that illustrates how does the bond function. Okay, so this is, let's assume Apple. Okay, Apple. Okay, so Apple needs money. Apple needs to raise money. Apple needs to raise some capital. So what does Apple do? It has two choices. Let me just draw it in the middle. Okay, so we have Apple. The ticker symbol. The ticker symbol for Apple is AAPL. If you want to look it up. So it has two ways. Either issuing debt, means borrowing money from the people, which is bonds. Or the second thing is selling ownership, which means stocks. Issuing stocks. Alright? So, coming to the bonds. Bonds are basically denominations of $1,000. So, if you want to buy a bond, if you want to invest in the bond market, if you want to buy a bond, it's basically denominated in $1,000. So, you pay $1,000 to buy this bond. So you are giving Apple $1,000 of your money, but in return, you're getting, this is called the premium, and you're getting the interest rate that Apple is paying you, the interest rate. And the interest rate is basically called the coupon rate, or the nominal rate. So, let's assume Apple is issuing bonds. Let's assume it's 2012 this year, and the bond will mature. The bond will mature in 2016. So in 2016, Apple has to pay you $1,000, the face value that you paid, plus the interest rates. On the bond until 2016. So, and the bond usually pays semi-annually. That means it pays you 2 times a year. It pays you 2 times a year. 2 payments. Interest. Okay? So, let's forget this for a second and let me illustrate what does it do. So, the first payment, let's assume a bond, $1,000. Interest rate is 10%. So this bond is paying 10% interest per year on your bond. So this coupon payment is going to be $100. $100 per year, which is actually Hold on a second. All right, so the company, the bond is $1,000. The interest rate is 10% interest, and the coupon payment is $100 per year. But they pay you semi-annually, which means they're going to pay you 2 payments of $50 per year. For how many years? 2013, 14, 15, 16. For 4 years. Which is not that bad. But whenever the rates in the market until 2016, the interest rates are either going to go up or down, or they're going to stay the same. But if the interest rate went up, that means people are going to be able to borrow more, to borrow a bond of Apple for $1,000 for, let's assume the interest rate is going to be 15%. Okay? So, and you are already locked at an interest rate of 10%. So you're going to say, hey, well, I can invest in this 15 to get more money. So what do you basically do? The bond that you already hold, bonds can be exchanged between anybody. So if you hold this bond of $1,000 and you can sell it to your friend for the same thing, now the proceeds from the bond are going to go to your friend because he is the holder of the bond or the IOU. So, but whenever the interest rates are up, that means if you want to sell this bond, you can't sell it at par, at $1,000, because people are going to directly go and buy this bond that pays them 15%. So what you do is sell it at a discount rate. So you sell it for less than what you bought it for in order to get rid of it or in order to just sell it. So you sell it, let's assume this is $1,000, 10% interest. So you sell it at $700. You sell it at $700 with a paying interest of 10%. So the guy that bought, or the person that bought this bond from you, is going to pay you $700, and he's going to get 10% interest rate. But at the end, Apple's going to pay this guy $1,000 and all the interest rates that were issued. So this is whenever interest rates go up. But whenever interest rates go down, you sell this bond at a premium, at a thing they call a premium. So what is a premium? I mean, let's assume the interest rate went down. Let's assume the interest rate is now 5%. Your bond, you are locked in a bond. You are locked in a contractual obligation with Apple to pay you 10% on this $1,000 bond. So if the interest rate went down to 5%, you can sell your bond at a higher rate. You can sell your bond for $1,500. That's a ridiculous number, but anyway, you can sell it at a higher than $1,000, but they will get 10% interest rates for the next 4 years. And at the end, they're going to retrieve this $1,000 from Apple, and all the interest rates, interest payments that were issued by Apple. So this is whenever whenever you hear volatilities and interest rates and stuff like that. So what determines this interest rate? What determines what interest rate? What determines which company do you want to invest in? So basically, let's assume Apple. Apple is a very stable company. Its financials are looking great. It has potential to grow. It's a very prominent and prosperous company, at least in the near future and in the far future. So it doesn't have to pay as much interest on its bond because it's stable. It doesn't have that much of a risk. So its risk ratio, its risk is lower than any, let's assume, ABC company, which kind of looks sketchy. Their financials are not looking that great. It doesn't have that much potential to grow. It might decline. It even might go bankrupt. So this ABC pays you a higher interest rate than Apple, so that you can lend this company money by attempting you to buy those bonds at a higher interest rate because they're paying more. But you're hedging more risk because you don't know where this company will actually end up. So this is basically the fundamentals of what a bond is. And I had a couple other notes that I wanted to talk about, but I think that this video is only for the fundamentals of how does a bond function and what is a bond. And let me see what I got here. Okay, one more thing. So, whenever they say treasury, the treasury bonds or the treasury securities, that means it's the debt of the federal government. It's the debt of the United States. So whenever the federal government issues those bonds, that means they're collecting money from the people, from the investors, which are basically not people, me and you. Well, you can obviously invest in the bond market, but what they actually rely on is investment banks and hedge funds, mutual funds, all those big entities that they've got like millions and millions of dollars going through those entities. So yeah, this is the treasury debt. But whenever you hear the term called municipal debt is more of local debt, like cities or towns, even like small towns or municipalities. They issue those debts in order to probably enhance the city that they live in, enhance the roads. It's just a term of financing themselves throughout those investors and throughout those debts and interest rates. What makes the bond market very attractive, it's because basically the global economy runs on debt. So instead of selling ownership, they issue bonds and bonds and bonds and bonds. That's why the bond market is very necessary in the current financial world, or financial, as my professor says. So yeah, that's basically it for the bond in the bond market. In the next video, I'll probably talk about how would you value a bond if you have this bond, because those interest rates are not going to be the same. The value of those interest rates are not going to be the same 10 years from now. If you had a bond that pays in 30 years, you have to look at the present value. You have to project your cash flows and you have to project your cash flows and determine the present value of those interest rates or of those bonds. But I'm not going to go into that today. I hope you enjoyed my little scribbling here, but I just wanted to emphasize my point for all of those visual learners. I'm just going to stop here. Thank you very much for tuning in. This is Brad Zara with you. Please, if you want, you can leave a comment, subscribe, or like the video. I'd really appreciate that, and thank you very much. Later.